guys. So again, you've seen what Scott presented to you, and that's exactly as an accountant what I want. I hate shoe boxes. We get the shoe boxes full of receipts, and the first thing I do is... So guys, Excels are important. It's going to give your advisor a very good snapshot into how things are travelling. It's going to give your accountant a very enjoyable time doing your return. I'm a big fan of Excels. I do them, Munziril does them, and a lot of our clients do them. But it is very important also for your own learning. Big one there is obviously speaking to your advisors, getting the right advice. You've got all that information. People like Ross and Scott can jump into it, make a decision. Your accountant, like Munziril, can make a decision, and you move on very quickly. The last one there is for PAYG variations. So PAYG variations is something where instead of you waiting until the end of the financial year to get your tax refund, you're actually getting a little bit of that tax refund each and every week through your pay. And you can only do an accurate PAYG variation when you've got all your substantiation, your Excels, your records up to date. So for people with poor cash flow because you've got quite heavily negative geared properties, that PAYG variation can assist you with cash flow throughout the year instead of getting a lump sum at the end of the financial year, which could go to potentially other properties or potentially sit in your offset account. But there are severe penalties if you do understate your income, which means that if you get a PAYG variation in place, you get a large sum of money throughout the year and you've got to pay tax at the end of the year, the ATO can impose a penalty and interest. So without having present information, without having it timely for your advisor, no one can give you the accurate advice.
I suppose, Jeremy, my personal view with the PAYG variation is that we do the PAYG withholding variation if we have to. The comment which I sort of say is that you, as an investor, if you're really that close that you just need that extra $100 or need that extra $200 per week to keep your sort of funding going, I think you really need to look back your entire sort of the portfolio. And you really need to look through that, are you sort of sitting in that sort of a high risk? I mean, the interest rate could increase, I mean, things happen. You can have the hot water system and this and that can sort of collapse. You might not have the tenant in there, right? So your mitigation is very important. Your buffer is very important, right? And whether you really have to rely on that PAYG withholding variation. I think that to me is a little bit of a sort of an alarm bell. The other comment which I was going to say, Jeremy, one of the risks of sort of that sort of timely and present information to your advisor in the right way, if you don't do it, right, I mean, who knows you're funding the most, right? You do, right? I mean, we may have the technical background, we may have the experience, number of years of experience, we may see a number of clients on the similar ground, but there are still things that we don't know of what you may have done. Right, so typical things as we check that when we look through an investment property, have you got 4 council rates? Have you got 4 water rates? Have you got your insurance payment? Is it a yearly payment? Is it 12 lots of payment? Have you got 12 lots of interest payments as such? So all of those typical things that we do. But if you went ahead and if you spent, say, a $700 on a repairs and maintenance and you paid it by yourself, so it hasn't come through your agency statement, how do we know it if you yourself haven't provided that details, right? So those are the things, and that's the risk.